All right. Good morning. Hey, Jeff, how you doing this morning?
I'm doing fantastic, Adam. Thank you for having me.
Absolutely. Well, thanks for doing this. And I want to really get into the details of why we're doing this. But can you just tell me a little bit of background about Fortitude Investments? And I know you're an expert on 1031 exchanges, so I wanted to provide some value for the people today. So give me a little bit of background about yourself.
Absolutely. So I'm a securities broker for 25 years. We created Fortitude Investment Group back in 2010 to provide a need for clients that have highly appreciated real estate assets, but they know they want to dispose of these assets, but they no longer want to be active landlords. But they also do not want to pay the capital gains tax that could be enormous on the appreciated values of these properties. So therefore, I represent multiple multi-billion-dollar sponsors throughout the United States that have products that are called Delaware statutory trusts, which are securities. And what these products are is these companies go out and they buy, and it could be any type of sector. They could be multifamily, they could be self-storage, hospital, hospitality, student housing, you name it, all triple net retail. And what they'll do is they'll do an incredible amount of due diligence on these products, on these properties, and then they'll wrap it up into a DST, a Delaware statutory trust. And exactly what that is in the past, going back 20 years when we had the economic crisis when the real estate market plummeted, TIC investments were very popular, and they were limited to 35 investors at that time. And a lot of real estate investors, as we know, they carry debt on their properties, their investments. So when they were going into these programs, each individual had to get underwritten by a bank. And then when it came to sell, trying to get 35 people to agree on a sale price was virtually impossible. And then when the downturn in the market hit, a lot of these deals blew up. So in 2004, actually Internal Revenue Ruling 2004-86, they created a Delaware statutory trust. And basically, it's a trust structure that owns real property. And you could have up to 2,000 investors in this particular trust, and the owners own a beneficial interest of the property. So, for instance, let's say a client bought a property 30 years ago for $1 million, and now it's worth $10 million. And this individual wants to sell this property, but he doesn't want to buy another property locally. He's tired of managing the asset. He does, the roofs, the boilers. We call it the 3 T's: the toilets, tenants, and trash. So what we do is we provide them with an option where they can actually sell that asset for $10 million, and they can roll that full $10 million tax deferred into multiple DSTs, and he can get an income stream for himself anywhere. It could be anything from 4.5% to 6.5%, and he gets monthly income, and he's completely passive. Programs typically by prospectus, because these are securities, they last about 7 to 10 years. They can go sooner. They can go the full 10 years. But what it does is it provides continuous income streams for the clients with a completely 100% passive role. The interesting part about it is many clients have either selling all cash, but many clients also have debt to replace. And when you do a 1031 exchange, you always have to replace the debt and the equity. And the nice thing with the Delaware statutory trust investments are that they come with pre-existing debt on them, many of them. So, for instance, let's just say hypothetically it was a multifamily, 500-unit Class A multifamily DST, and the institution put 50% institutional financing on it. If a client was selling a $10 million building and he had a $5 million loan that he had to obviously pay off when he sold the property, and the funds, the $5 million went to the qualified intermediary, he'd have to pay the other $5 million back to the bank. In this scenario, it's very simple for him because when he exchanges into the 50% levered DST, his debt is automatically replaced, and there's no underwriting of the individual. The debt doesn't show up on his credit. it's non-recourse to him, and his exchange is completed. So it makes it for a very smooth and simple transaction. If a client is 100% cash, a lot of clients might want to choose to lever up. So the benefit there is if they sold for $10 million and let's say they were all cash, they could actually go into a diversified portfolio of, say, 10 different DSTs, and those 10 different DSTs could have 50% loan to value on them. Essentially, he's buying $20 million worth of real estate. So that additional step up in basis, he'll be able to get much tax-deferred income that'll be passed through to him. And the way it works, too, is it helps investors that might be sitting on assets that they've had for many years that are very hesitant to sell due to the tax implications that are associated with it. And now it gives them an easy exit because they can sell this asset. They can go into a diversified portfolio of DSTs, get that income stream, not have to do anything except collect checks on a monthly basis. And then when the institution sells it, they have their choice either to do their own 1031 out of that into something else, either pay the tax or go into another Delaware statutory trust investment. The whole idea here, and we consider it one of the best financial estate planning tools that are out there, is because many of our clients have beneficiaries. So as we all know, when you die, your beneficiaries get a step up in cost basis. So the old adage in the industry is swap till you drop. So people continue to do these 1031 exchanges. So eventually when the time comes, and we all pass, our beneficiaries now get to step up in cost basis. So when they do sell the property, the institution sells the property, the kids have their choice to take the money and do so as they please with that.
Awesome.
Yeah.
So just to back up a little bit, so about Fortitude Investments, I know you've done I think we were talking earlier about 600 million in 1031 exchanges. Is that correct?
Yeah, more than that. Over the years, I mean, the number's probably over $1 billion. We've done them in all shapes and sizes, and it's a good point that you bring up, Adam. The fact that you can go into a Delaware statutory trust investment on an exchange for as little as $100,000. So they're very kind for somebody that maybe has a smaller exchange, like a $500,000 place that they're selling that they bought for maybe $50,000, and they can go into 5 different DSTs for $100,000 a pop and have a diversified portfolio.
Right.
The only thing is, like I said earlier, they need to be accredited, which means they have to have that $1 million net worth minus their primary residence or $250,000 income for the previous 2 years. But they are, and you could also buy them directly. Clients come to us and they buy them as cash investments because they know of the estate planning feature with them, with the step up in basis that they will receive, and they can keep swapping them to the inevitable.
Right. So this is a niche that you actually primarily focus on?
It's about 98% of our practice, right? We do 1030. 1031 is probably about, I'd say 80% in 1033 exchanges, which is eminent domain. It's a little more flexible in eminent domain, but it works with them as well.
Can you talk, I know when we spoke a day or two ago, you brought up about an eminent domain transaction. Can you talk a little bit more about that in detail or not?
Yeah, that's kind of a good question. That's how we got into the industry, actually. It was about 20 years ago, and one of our clients, they had a parking garage in the city, and the city came in, they had to put pipes for this parking garage. So the client, when you have an eminent domain in the state or municipality takes the property away from you, you actually have 3 years. You can actually take constructive receipt of that money. Unlike a 1031 exchange, you cannot take constructive receipt. So if you were to sell a building, you have to hire a qualified intermediary, and you always want to deal with a qualified intermediary that is nationally licensed, insured, and bonded. And that money will be held in a segregated account in your name. Then you have 45 days from that time that you close and the money's given to the qualified intermediary to identify replacement properties, and then another 130 days after that 45th day to close on the property. What is great about the Delaware statutory trust investment is if the client knows they want to go the passive route, we'll already have a portfolio put together in place before they even close. So when that money hits the qualified intermediary account, we can actually close them into their institutional quality properties in 5 days or less, and the income starts immediately. So if they were to do this themselves, okay, it could take a 6-month period, especially if they have to go out and get financing on debt. So on $10 million, if they were getting, let's say hypothetically, a 5% rate of return, that's a huge chunk of income that they lost for that half of the year, whereas their income is starting immediately. Those funds are placed into those institutional properties.
Okay.
And to get back to your question on the eminent domain, the eminent domain scenario is you don't need a qualified intermediary. You actually can take constructive receipt of the money. You have 3 years to do whatever you wish to do with that money. But after the 3 years, you have to do the exchange or pay the taxes.
Right. So there's something that you mentioned to me that is out there that you wouldn't recommend to people, as far as like 1031 exchanges and things that you might see out there, or things that pop up that look similar to the DST. Is that something that you can think about?
Yeah. So the Delaware Statutory Trust, acronym DST. There's also another product out there that's being touted all throughout the internet that is called Deferred Sales Trust. That acronym also is DST. And basically, there's no private letter ruling on file. Now, I'm not to say that you can or cannot do it. We just been advised not to bring that to our clientele because there's no private letter ruling on file from the IRS that we're aware of. Whereas the Delaware Statutory Trust is built into Internal Revenue Ruling Code 2004-86, which is qualifies for 1031 exchange. And so that's just the reason why if clients do ask us about that, we just tell them, stay away from that.
Okay. And then I know when we spoke the other day as well, was there any other products that you wanted to mention? I mean, it seems like you're totally not an expert on this. I'm just kidding. But is there anything else that you'd like to share as far as like if I brought a client to you as far as other products or anything else that you would, recommend? I know you work with the biggest CPAs or the biggest accountants in New York City. So do you have any other?
I do. So I mean, the most important thing that I could say is when a client is anticipating an exchange, one, you want to make sure, your real estate attorney is in contact with us. The real estate broker such as yourself is in contact with us. The CPA is in contact. So we need to educate them on the Delaware Statutory Trust investment. Also, you want to know how is the property owned, because anytime you do a 1031 exchange, however the property is titled is how it has to be titled into the replacement property. You could always change title after the exchange is completed, but it has to be a like kind exchange. And that doesn't mean that if you sold a multifamily building, you can't go into a self-storage portfolio or a triple net portfolio or a whatever, a hotel hospitality portfolio. It's just like kind property. As far as what else? I mean, there was a lot of things that can go on for hours on this topic, because we do CLE, CP, and C credit courses, which I would invite all of your associates to come to attend. We do them in Manhattan all the time. I do them around the country to educate you on these types of topics, because more brokers need to know about this, because we're not competition with real estate brokers. We're a complement to your business, because you have a lot of clients or prospective clients that are out there that are sitting on assets they had for a long time that want to sell. They just don't want to pay the tax, and they don't want to make a lateral move due to the cap rate compressions that you're seeing in Manhattan in the 5 boroughs. And here's a way where they can sell the property and diversify themselves out throughout the country and have institutions that have been around for 40, 50 years managing these assets for them and be, like I said, professional check collectors.
Right. Before we get offline, there's one thing that I read recently, if you can speak about it, about the family portfolio that you moved over?
Right. So it was a family that we would do. This is a family that's been in real estate development for many years. And they decided they wanted to get out of real estate management. They wanted to get more into development. So because we've become experts in 20 years, I think we're number one or number two in the country in our space in what we do. They sold off about $176 million portfolio or in that range. But there was multiple LLCs, multiple trusts, and we have a team of individuals that were able to execute that transaction, get it completed in a timely manner, like I said, to the point where we were able to close that out for them, have them diversified it, and it must have been about 25 to 30 different DSTs. And let me preface by saying a DST can hold one asset, it can hold 30 assets. So you can actually, by owning multiple DSTs, you can end up owning 40, 50 interests in 40, 50 buildings. So and the other thing I want to point out to make clear is if you buy if you bought into a percentage ownership of let's say it was a $100 million Class A multifamily, and that multifamily had 500 different units inside of it, okay? You're not buying into one unit or two units. You're owning the beneficial interest of all 500 units, and there's a master lease on that's held by the sponsor. So, and the sponsor handles that all. So you're getting your income stream, on a monthly basis. You're not having to track down those individual tenants. And then when the trustee deems it's time to sell that because they're getting the best price for the investors, the clients will get a letter 60 days in advance saying, get your qualified intermediary in order. And what happens is you go through the same process that we explained earlier. The monies will go back to the qualified intermediary, and the client will have a choice simply either to do another exchange on their own, go into another DST, or pay the taxes.
Okay. Awesome, Jeff. This was really amazing. A lot of knowledge you brought on to us. Do you want to let the people know the best way to contact you?
Yes. So my website, it is www.1031dst.com. So 1031dst.com. I can always be reached on my mobile phone because I travel a lot. It's at 631-379-6013. If you want any information, you could always email me also at JKIESNOSKI@fortitudeinvestments.com. My contact information is there. We have offices in Manhattan, Long Island, Jersey, Palm Beach, Florida, California, Utah, and Boston. And so
all the great markets.
Yeah, we're national. We're a national firm. We deal with clients in almost every state. So, and we're a 24/7, just like yourself, operation. Weekends, no problem at all.
Right. So, and also, if people want to get in touch with you, they can also message me directly on Facebook.
Absolutely. They can message you, and I would encourage them to reach out to you. And I, at a drop of a dime, I will come and I'll sit down. I'll come to your office. If anybody wants to do a one-on-one, I'll do one-on-ones to educate them further, because there's a tremendous more. And our courses are generally 2 hours, so we kind of jammed 2 hours in 6 minutes. So there's a lot more to talk about, but it's a good start.
Okay, great. Well, I appreciate you doing this. I know your time is valuable, like everyone else's. And again, if anyone wants to reach out to us, just you can reach out to Jeff through his contact information or through me on Facebook. And any other questions, I'll send them to you.
And Adam, I really appreciate you for giving me the opportunity to speak, and you have a great week, okay?
I'll talk to you soon, Jeff.
You got it. Thank you.